Good morning, everybody. Welcome to the Flow Show. And what an explosive day we had yesterday. Just when you think things are a bit quiet, boom, we get a couple of grenades getting lobbed in. Just before we start, just want to bring your attention once again to the offer we've got going on our trader funding program. As you can see there on the screen, if you take a trader funding program assessment in the month of July, you will get a free 45-minute one-on-one session with the man himself, Mr. Blake Morrow. So if you want to take advantage of that, that applies to any size assessment. You'll also get free access to ForexAnalytix for a certain period of time, depending on which assessment you take. So the minimum cost, I believe, is about $250. So you'll get a coaching session, access to the ForexAnalytix platform, and obviously the opportunity to expand your trading armory if you're looking to scale up. If you've got a small account, trade up to $25,000. That's the minimum account size we do. So have a look at that offer. I'll put the link up in the chat shortly. But in the meantime, let's crack on with the rest of things. No K today. He's got some jobs to running around doing today, so he's off. So it's just me, myself, and I to keep you company. We'll start off in Japan, but just doing some of the headlines, and we'll talk about the intervention stuff later. Bank of Japan's survey showed that wage growth was spreading among small and medium-sized firms this year. This was something that was touted a week or so ago, that they would be acknowledging that wages are becoming wider spread across the country. So that's good news. The government, however, looks set to trim its economic growth forecasts, according to sources speaking to Japanese press. So there may be a little bit of a downgrade coming to their assessment of the economy. One of the Japanese business lobbies, Duyuki, says that they want the BOJ to raise rates at the July meeting. So this is a bit of the pressure coming in from some of these business lobbies and the like. We'll move on from Japan. I'll come back to the intervention stuff a little later. We've had a bit of data out this morning. Got some data out of China, trade balance data, which has improved. Bit of a change. I've seen imports down, but exports up. So that's a good sign there. Hence why that trade balance has moved more into surplus. Shows they're exporting more. Shows perhaps a little bit more activity under the surface in June, with that rise of 8.6%. But those imports coming down, as I say, doing a lot of that movement there. We've got a bit industrial production data from Japan as well for May. Showing a decent rise there, 3.6%, beating expectations 2.8%. Their capacity utilization going up 4.1% as well. So again, just showing a pickup in activity in Japan. And as we've seen from various data points, there has been an improvement, although some sectors are still looking a little bit wobbly, shall we say. We've had a load of CPI data coming out from around Europe. Swedish CPI there coming in a little bit softer than expected, 2.6% versus 2.8% expected, down from 3.7%. And some of their other numbers as well coming in softer. So getting a little bit of a wave in some countries of this softer CPI coming down. We saw Norway's CPI looking pretty similar as well. We've seen it in other countries also. These were some final numbers from France. Well, let's go over Germany first. Some crappy numbers there from wholesale prices. Still showing disinflationary, nigh deflationary type numbers there. The rest were final numbers. France final CPI just ticking up a pip in their main CPI number, but coming in unchanged in the Eurozone measure. CPI in Spain as well, coming in all as expected, though the HRCP did rise above expectations by a pip on that one. Their core number, CPI, staying unchanged at 3%. While we're on data, we'll go over to well, we'll go over to the US CPI because that really got the ball rolling yesterday. Firstly, continuing claims or jobless claims coming out, all tickety-boo there, still in the 200s, 220s, 230s. Continued claims in the 1.8 million. Move on from that, nothing to see there. CPI, right, so headline CPI came in softer than expected at 3%, was expected up to 3.1%. The core came down a bit lower than expected to 3.3%. There's been a lot of diving in the numbers, some of these real sticky items, services, rents, housing, occupy, all the stuff that the prepared heads like to get stuck into. They all showed signs of coming down as well. So on the face of it, softer numbers than expected. The market's, as usual, probably overreacted. CPI has been with a 3 handle for 13 months now. Until it shows a 2 handle, I'm not going to get carried away. Yes, some of these stickier components have come softer, and that needs to be monitored to see if now this is going to start trending lower properly. What isn't such good news, and it's not on this calendar, but it's important nonetheless, is that real average hourly earnings year on year rose 0.8% from a prior 0.7%. Average weekly earnings year on year rose to 0.6% from 0.5%. Now, we've had some Fed members telling us that wages are coming down. Not according to these numbers, they're not, and not in June. So that's another reason why this data is not as dovish for the Fed as many are jumping all over. Now, straight after that data, rate markets, as I say, started repricing September. They rose from 70% before the data to 85%. Chance of a cut in September. Not long after that, it then priced a full 25 pip rate cut in September and a 25% chance of a third Fed cut. So we've moved from 1 cut this year in pricing to 2 cuts, and now we're starting to price in 3 cuts. This is the market doing its thing and usual thing and running from one side of the boat to another. They may be right this time, who knows? JP Morgan might be right this time. They've revised, one of the first banks to revise their rate cut calls. They've moved it to September from November. I think they moved it from September to November at the last count. So, you know what I think of bank forecasts. But anyway, this is the market, as I say, running from one side of the boat to another. That data also got some of the rate moves, some of the rate expectation moves happening in other central banks as well. For example, the ECB stepped up to about 20 basis points now for September. So all these moves in that we get in rate expectations tend to reflect across the other central banks as well. So anyway, as we were all sitting there watching what the dollar was doing, getting sold off, we've got what is highly likely to be intervention coming in, as anyone who was sitting at the desk yesterday would have seen. Now, according to BOJ accounts data, and I've been digging into this all morning trying to find where they get these numbers from. I've actually found it, but I can't make sense of it because it's taken from some data, daily data that the BOJ produce for their current account and changes in thus, and then it's matched off against the data from banks. Banks make calls, on what they think is the Bank of Japan is going to do. So there's a lot of, taking stuff from somewhere and adding it to this stuff and adding it to that stuff and put it all in the pot, and people come up with this number. So it's a comparison of Bank of Japan accounts and forecasts from money brokers. So it's not easy to get the money broker forecasts and match them off with the BOJ stuff. So there's no real way, I think, at the moment of getting a heads up on this sort of data, try as I might. But anyway, they reckon that they intervened to the tune of around 3.2 trillion yen, which puts it's a little bit softer than we saw in the last interventions. I think the last interventions were, I think, 5.5 trillion, and then obviously 3.5 trillion, or just over 4 trillion. It was just over 9 trillion in total, I think, if I recall correctly. So this one might be little on the low side, but we won't know officially until the end of the month when the Ministry of Finance give their intervention report. So we got it getting smashed up. We did have a headline not long after from TV Asahi citing a government source saying that they intervened in the FX market. Kanda decided to pop up not long after. He was a bit coy. So he's not in a position to say if the government intervened or not. And then he decided to pretty much blame it on the data. He said the market is wondering if it was a reaction to CPI or another catalyst. It says the market view is rational based on US CPI. So he's trying to redirect eyeballs that it wasn't them intervening, it was just the market reacting to the CPI data. He then went on to say FX fluctuations are large and differ from fundamentals. FX moves that are not in line with fundamentals are quite concerning. If we did intervene in FX, we will disclose at the end of July. He doesn't see the recent FX moves as stable. Since then, we've had all the usual officials, Hayashi of the cabinet, Suzuki, all coming out, not commenting on any intervention, but saying that markets need to move in line with the fundamentals, blah, 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 blah. So it's a big denial, and no one's admitting to anything, but maybe those numbers suggest that that they have intervened to that amount. Now, one thing that is potentially different is that overnight, apparently the Bank of Japan conducted a rate check. This is one of their lines that they can use. Usually they do that sometimes before intervention. They will make it clear that they're phoning around checking rates, and that gives the market a little bit of a spook and gets it sort of moving in their direction already. But apparently they phoned around and they were asking for a rate check in euro yen. Why is that significant? Well, they tend to only intervene in dollar yen. If they intervene in other currencies, that's usually by using their other agent banks around the world in whatever country. So if they want to do euro yen, they might tap up their lot in Europe. In some cases, even the ECB to enact their agents to go and play in that currency. So this might be significant. And this is purely my conjecture in this, is that checking another currency, another yen pair, just may be a little nod to the market that they're prepared to maybe take things a bit broader than they have been now. So that was the reason why we got this move overnight, because that was a rate check. But as you can see, we've recovered. So why have they intervened? This is something that I mentioned yesterday in our chat room. There's, and I mentioned it here, there's a Bank of Japan yen index that had been continually falling. It was at a low yesterday of 74.77. And as I noted in our chat room, we'd been seeing yen weaker in the crosses all of yesterday and the day before. In fact, yen crosses breaking their prior highs. The only one that wasn't going was dollar yen. And that had me thinking that I was a little bit cautious that if this CPI data yesterday, there wouldn't be a number that would send dollar yen meaningfully lower or the dollar meaningfully lower. So what might have happened is that I saw two cases, irrespective of what happened to data, where dollar yen perhaps caught up with those yen crosses after getting over the speed hump and then went on to break it. And if we did that, that would really put us into intervention territory. It looks like maybe that was the straw that broke the camel's back, that index, because today it's trading up at 75.89. Obviously, that's a reflection of what's moved in so far. Now, why did they intervene after the CPI? Well, if you're going to push a market over, you might as well push it while it's already stumbling. They would have spent a lot more money intervening had dollar yen rallied up through the highs and through 162, and then they'd be going against a market already buying it. So they're going to do it while the market's going the right way. So the warning signs were there. I'm not going to say yes, I called it. The warning signs were there. Hence why I watched this index, because it was at a very low level. And just the way the price action was playing out, I thought dollar yen might have been on going for a little wander higher after the data. But their views and their reasons are their own, and we shall never know. So anyway, they've decided to intervene. They've given it a smash down, the usual 300, 400 odd pips. And now we're into what next mode. I think we still need to be cautious. That little line on checking rates in euro yen just adds a bit more uncertainty. Are they going to do something different this time? Are they going to change it up? Are we going to see a prolonged period? Maybe they come in a couple of times rather than, they did it a couple of times last time. Maybe they're going to do it 2, 3, 4 more times, or keep rate checking, or just something that's different from the norm. Because what they know is every time they've intervened, it's come right back again. And yes, they give speculators a knock on the head, but those speculators have come back. So what we might find now is similar to when we got the prior interventions. The market is going to be a little bit more nervy about things. Let's just come out a little bit so we can get those prior interventions in that came across the end of April into May. After that, we did have a rally, but then we took some time just to steady ourselves a bit. So we could go all the way back up, but they intervened twice there. As you can see, we had the first intervention, then it rallied back, and then they knocked it again, and then the market got a bit more moderate, shall we say, or cautious. So it's all going to be on the speed of this. I think if we back up to 160s, then there is a high risk that they may come in and tap it again, just to say, here we are, don't forget us. Or they may not. This is that situation still where you don't know which way to go. I very nearly bought the dip straight after the CPI because I thought, yeah, it might be going back up. But fortunately, I set my hands, and that proved to be a good case, because then they did come in and spank it. So from here, if you're trading the yen, you can be brave and buy the dip in the hope that it's going back up. You can try and get short in the hope that they come in again. You still face the same risks that you faced before they intervened, in that you don't know what they're going to do and when they're going to do it. So volatility is still strong in this one, and you need to be very careful if you're trading it. If you've got any questions about anything like that, just throw them up in the chat there, and I'll try and answer them as best as you can. Zhao, yeah, it's anywhere between intervention that I've seen is usually anywhere between 300 and 500. It's usually around 350, 400, maybe 450. It depends. There's no set amount really. They just hammer it, and then stop hammering it, and then the market does half the job for them. There's going to be tons of stops and people rushing to get out. So, they don't hit it for levels. So they don't say we're going to intervene for 400 or 500 pips. They probably intervene for maybe 200, 300, and probably a lot of the market does the rest of the job for them as everyone's panicking and smashing the sell button. But that's the ballpark for it. So if you're trying to catch a reversal when you're sticking bids in 400 or 500 pips below, yeah, you might catch it, but you got to be careful with that side of things. Right, so let's just go on to some other news, and we'll get stuck into the prices in earnest. We've had Fed's waffling on. Fed's Daily says that it's likely some policy adjustments will be warranted. Said the recent inflation prints are a relief, but the progress is bumpy. Says the economy looks to be on a path where 1 or 2 rate cuts this year would be more or less the appropriate path. Fed's medium is still at 2 cuts this year. So again, the Fed have been at 2 cuts they were 3 cuts. They're now down to 2 cuts on the median dots. It's been the market that's run around between those numbers, going a little bit more to the hawkish side, and now they're coming back again. She also said it's a fairly big signal from the Fed that so many of us are talking about the labour market. So that's putting attention ever more onto the labour market, the jobs numbers and whatever. Fed's Muslim says he supported the Fed's rate decision at the June meeting. Monetary policy is restrictive right now. We are making progress on inflation. CPI data points to encouraging further progress, but wants more evidence. Inflation is moving to 2%. Companies are saying that wage growth is returning to pre-pandemic levels. Fed's Goolsbeast was doing a little bit of a victory lap. Said the June CPI report was excellent. The improvement on shelter inflation profoundly encouraging. And he went on to say, this is what a path to 2% inflation looks like. And I'm going to laugh my nuts off if next month's CPI data goes higher, because that will blow that comment out the water. Anyway, he says as inflation falls, leaving Fed policy rate steady means the Fed is still tightening policy. The reason to tighten policy would be if the economy is overheating, and we are not overheating. Right, last item, and I'm not sure what to make of this, whether we should make anything of it. We had a 30-year bond auction yesterday, which didn't go off altogether that well. Bid to cover was 2.3 versus 2.49 previously. There was a drop in indirects, and obviously the yields got mucked around. So on the face of it, it's a bad auction, but given what the bond market was doing yesterday, in between the CPI data and the rest of the day, I'm not sure if there's just a little bit of a skew there from circumstance, rather than it being a bad auction for the sake of no one wanted to take part in it. So, you know, when you got these yields moving that fast, it can create a little bit of waves for the auction. So I'm not going to declare it bad, and you know, there's the end of the world coming, but we'll have to see how the rest of them turn out. But on the face of it, not a good auction at all. Just seeing if I've missed anything. No, I think that's it on the news front, all the big stuff that's going on. So now we can look forward to seeing what's going on. Probably sticking with yields, this is probably the most important thing to keep an eye on today. After the CPI data, yields dropped. We got under that for 20%, hovered around below it for quite some time. But as you can see, we're back above now. So the market's had its little flip out, thrown its toys out the pram, but it's come back, or it's coming back round about, you know, things are calming down a bit more. We're back above this 420. We're holding above this 420. So you can see what a key level this really is. If we get under there and hold under there, that's when you're going to see the dollar selling really picking up ahead of steam. But for now, dollar selling, you know, it's holding, you know, cable's holding up in the 129s. Euro dollar's holding up ish. It did have a little move up to the 109 figure, pretty much tapped it on the head, but then it came off since. So we are holding this, but I think we might be finding things a little bit more balanced. We may have just moved up to another plane. So I'm not expecting any straight lines for dollar selling, particularly while those yields have bounced. So I think we're probably going to find resistance on another move up towards this 109 highs, 109.10. If we do start breaking there, then maybe something is happening. So 109, 109.10 is the level up here for euro dollar. You can probably pick the levels after that, every sort of 20, 30 pips. My next level above there is up around this old 50 fib, 109.40s. It's been a prior resistance point as well. We've had plenty of traffic along that area, support and resistance. So that's a fairly chunky level to keep an eye on. Above there, Had a little bit of traffic, 109.60s, and then it's all about 110. So for now, it's keeping the momentum from this move going since the end of June. So that's encouraging, but we're still in, some pretty well-worn ranges. This is maybe a little bit of a break of this trend line here. This is just a reflection. It's not really a tech level or tech levels that I'm using to trade. It's just showing that we've been in a steady downtrend since the start of the year. We may be starting to break it. I think above 109.10, then perhaps something is changing and we are going to turn around this yearly trend. The market, been saying it for a while, is in dollar bearish mode, and any excuse it gets to smack it, it's going to do so, and it did it again yesterday. We do have PPI data up today, so that's either going to add or subtract something to the CPI data from yesterday. So just keep an eye on that one. If it's a hot number, then it's going to probably wash more out of this move we've seen. Probably see yields moving a bit higher, and the dollar slowing at least. I'm not going to say it's going to go the other way, but it could slow. It's already expected to pick up in the core PPI, so that's expected up 2.5%. PPI headline up a pip to 2.3%. So just keep an eye on that one in case it's hotter than expected. Obviously, if it comes in lower than these and lower than last month, that's going to feed into what we saw yesterday from the CPI, and we probably get another round of dollar selling. To what magnitude, I don't know. That's when you need to watch your levels, like 109 in euro dollar. We've had quite a few pairs up hitting levels. Cable, it busted out through the 129s. That's holding pretty. Still that UK exceptionalism, shall we call it, for now, leading the pound to walk a bit further and faster than euro dollar. No surprise to see 129.5. As is the case with cable, you get a lot of action between the big figures and the half figures, as we've been pointing out. So all eyes on 130. Can we take it on today? Can we even break it? I might be eyeing that one for a big figure scalp, seeing as we haven't been there for the best part of a year. So I'll be looking at that one. But as I said, a lot of levels tested, but a lot of levels holding. We got a test in dollar CAD. I'm a bit thankful for this one because I've got my sell stops running at 135.80, and I didn't pull them. I probably should have, but I didn't. And fortunately, the spike down wasn't enough to get through and ping those stops before it bounced. But we've had a little test of this zone, and it's held where it needed to hold. So this is why I say every time we got big data, pick your levels, look at the places you want to trade. If you wanted to get long the loonie, 136 down to 135.85 was the area to do it. And what we have seen is a move back up, and it's got up to the old level, 136.50 again, and that's where we found resistance. Things are a bit more balanced now in here. We'll have to see if 136 holds again. I think if we get another move through 136, I think it might be on its way. But we shall see. If we get another hold down here, that's going to look really strong for another bounce. So take this one for whichever way it goes. It still needs to get above 136.50 to break this move that we've seen here. So that's a big level that held over the data. Aussie dollar 68, big figure, tapped it. I think came up a pip short, if I'm not mistaken. And there we go. We've had a bit of a pullback. Not that much of a pullback, but it's just showing you where the resistance was. So after the stretch, you hit a big level, and it's going to pull back from that one. It needs to do something more now. If we have another test up there, then perhaps we're going to get a bit more of a solid top, and then we may be looking down towards the 67s again and seeing where we're going to range and seeing what it wants to do in the meanwhile. The bigger level is really up towards the high 68s, and these highs up here, this zone, 38.2 fib. It's a big old zone up here. Again, it's another one that goes back and back quite some way in time. So you can see we've had plenty of price action along this area here. So that's going to be the big level up top. In the meantime, big figures are holding for that one. What of the yen pairs? Well, euro yen, obviously with that rate check, that took a big spank overnight as well, but it's back up here again. So I think back above 173.50s. Got a bit of a break point here. Let's stick a line in there just to keep all you painters happy. Back above here, then we're getting back into this area and this move, and that might get the MOF jumping up and down a bit. So there's a risk, as I said earlier, for trading the yen right now. You know, it looks enticing for a move back up, so you might think about buying it. But if it does go back up and they get pissed off with it, and they give it a spank, then you're going to be back down here again. So, you know, you need to be careful. If you're going to trade it, just trade it with smaller size. If you can get guaranteed stops, then obviously do that. Similar picture, obviously, in a lot of yen crosses at the moment. You might find we get in a lot of these crosses some natural selling if we do get up here, because people are going to have the MOF in mind. So it might just be a bit tougher to get up towards these highs again, because, as I say, naturally the market will have some sellers coming out and about, be they front running further intervention or just, you know, there's going to be some people who perhaps long up here, they haven't got out yet or haven't got stopped out, and they're going to use any decent rally to exit their positions as well. So the dynamics of the yen can change a bit in terms of market mood and how people view it at the moment. Dollar China, I had some bids in one against these levels here, 127, sorry, 727 and a half, 727. I've been filled on those. I didn't add down into this move here. I was looking more down towards this area if we got down there, but it bounced. This is just a sort of intermediate line. It's not really anything of note. It's just a pivot area, if you like, one of those levels that something happens at, and we bounce from there. Haven't managed to really make any inroads. It's holding up. I'll have a little decider what I want to do with this trade. I'm certainly going to start taking some profit if we get back above that 728 area. But again, this one is working on the back of what's going on in the dollar more so than what's going on in China at the moment. So that's the big influence there. Dollar MEX, that was pretty restrained over everything that happened yesterday. Did get a little bit of a move lower, but nothing huge. I'm still watching this 1740 level, which we're creeping towards. And again, just to show you, it's one of those big long-term levels. You can see it goes all the way back 2018. We've had touches along it. And as you can see there, support, resistance, resistance. And when you get support and resistance off it, you get some decent moves out of it. So obviously we've broken it in this move here. But when you've been away from a level quite some way and for quite some time, it can have an influence when it comes back. And obviously we've got some FIB and other tech around this area as well. So if I want to have a little knife catch, this is the level I'll be looking to do so. Don't need to give it much room. 1735, 1730s, then likely the trade is wrong. So, you know, I don't need to wait till we're down at 17 or 1670 to decide I'm wrong on that. Nice tight trade. As I say, maybe just below, stop below the 30s if you're looking at it. And then, you know, if it holds, it holds. If it doesn't, then you don't lose a lot having a go at it. Derej wants to look at metals. Sorry, Gavin got 120 to 120 ZB. I don't know if I've got that up. Let's have a look. No, I don't think I've got those up there. Well, I'll have a look at those. I've started in a couple of prices to my bond markets, notes and stuff. So I'll take your word for that one, Gavin. Right, metals. Let's have a look at gold. Because we got the break and we're trying to hold the break at the moment. Again, a bit of a reaction function. I love it when the tech plays nicely like this. You know, we knew 124 was going to be the level. We've got above 124, 2400. We've got above it. We are trying to hold it. You've held it pretty much on the nut, but you're going to have to be guided by what happens here. If you're long, fine, you've made some money. I hope you've taken some money on the break. You just need to be careful now what happens if we get a dip under. If we get a dip under and then it starts to hold under, likely we've seen just another quick fake out or quick extension, and then we're going back in the box. So your 2400 line is your key line here for everything. If it holds that, has a chance to move on higher. Maybe we get a test of that prior high 2450. If not, as I say, we could be coming back in, and then we'll see what this whole move since the end of June wants to do. Is it going to come all the way back, or are we going to hit some of these lower levels and bounce from there and keep the trend going? So, Dereg, what are you doing in metals, mate? You long, you short, sitting on your hands? Let us know what's going on, what you're doing. Silver, bit of a similar picture though. We couldn't get up towards its prior highs, so a little bit held back on this one. As you can see, it's come back pretty quickly into where it was trading previously. So silver not playing ball as much as gold, but we know that there's more stuff going on in gold than there is in silver at the moment. Oil markets, they had their little dip, didn't quite get down to the 80-50 area, but it's as Blake would say, close enough for government work, so it's had a little bounce off there. This 82-50 is just becoming a little bit washed out. I think we are still seeing a bit of action around it. If I zoom in a little bit, so it came below, resisted, and just getting one of these washing out moves going on here. So you could probably ignore that for now. But if we go away from it again, if we spend some time away from it and then come back to it, it might have a say. But as I say, it just might be washing out as a bit of a level. Keep an eye on these highs up into the mid 84s. 84.80 is a level I've got just up here again, just one of those areas when there's been a bit of action. Otherwise, we're looking at this big, maybe you can call it a double top, 87.60s high up there. But yeah, keep an eye on the geopolitical risk for that one, because we're not out the woods on that either. Yeah, keep an eye on that as well. Anything else for anything else, you guys and girls? I need to look at some other pairs. Euro Aussie, I've been keeping an eye on. It's still holding support down here. I know plenty of you lot trade this one, and I've been thinking for a while that this might be, if we get a breakdown here, it might just be a little bit of a kicker, because you're going to be seeing the Aussie probably breaking a few levels in various other pairs like Aussie dollar through 68. We've come down here several times. I know Gavin's got support around 160.20s, so that's important in itself. A little bit of protection off this big figure down here, but the bounces are looking relatively weak at the moment. You know, for trading wise, half decent. You can get 50, 60, 70 pips off of buying it down here. But for the longer, wider picture, it's just looking a bit iffy. If we get too many tests down here, you know my view, too many knocks on the door, one day the door will open and through we go. Looking at the PA on this one, I might be getting interested in sticking maybe a little sell stop under the big figure, just to catch a break. I'm not inclined to short it this just above this level, because it makes it a trade that could still go any way. But if I want to catch, if I'm not short from higher up and I want to get short, then I'll look for a break trade. And a break through the big figure looks like it might have a bit of legs, at least possibly down to this 58, 40, 50 area down here. So yeah, I might be eyeing up a few sell stops in that one. Just means I don't have to commit to anything. If it doesn't go there, I don't get a trade on. If it does, then it's likely to break. Yeah, we're going to be waiting for the PPI data. The PPI data, just to add something to that, it can be a bit more volatile than CPI data, so we can see bigger swings in the numbers. So gauge the reaction. You know, we could get 2 to 3 pips either side is you know, that's pretty standard for PPI type data. If it's 5-6 pips difference, then that means that it's moving a little bit more, but it can be a little bit more volatile than CPI data. So just bear that in mind if you're looking at that. Stocks, a lot of talk about stocks, obviously. And a bit of a strange reaction for this one. And we obviously had this big old move up through 56, got up to 56.50, and then it got a big stamp down. Now, I don't know if this was maybe just some profit taking. We've been talking about the divergences between stock markets at the moment, things like the S&P and the Dow and whatnot. I think this just might be another one of those trades. You know, that was just too much for some people. If you were long from down here and you caught that move and you saw that move, you'd probably be, I will be hammering the take profit button up here. The pullback so far is just, again, it's funny how these little levels work out. This is why you draw your lines in. You know, we had a bit of action up here. We had this high. We got above that high. We came back, and then we just found a bit of support there. Had all this move, and we found support right back here again. So again, I've been saying this all week. When you're trading something that's moving such as it is, when you've got no historical prices history to look at, to base a fib off, base anything off, unless you're doing extensions and whatnot, you just need to watch for these little levels. Just stick them on your chart and see what the price does when we get here. Because if you get something like that, well, if you wanted to buy the dip, well, here's your dip. And you don't need, again, you don't need to be wrong by much. If we're under that level, then we're probably going to head down here. If this level holds, it's got every chance of getting back up somewhere up around here. And we've had these moments all the way through this rally. We've had these breakpoints, comes back, tests these little support areas. I've got hundreds of lines here. Just when I was trading this, all just these little moves. Where does it come back to? Where's the support going to show up? And then you get some levels that are bigger than others. And so if you're trading this, you know, you don't need to get caught out. You don't need to be selling on a whim or buying any old dip. You know, you don't want to be buying it here because you've gone offside again. Wait until you get these little areas and just stick them on your chart. You can always take them off again later. And that's how you develop the price action, see where the real levels show up. If we go up to, I don't know, 56, 25, 30 and find resistance there and then come back down and bounce off this level again, then you're building up a level. The level's becoming stronger session by session, day by day, and then you can give it a bit more conviction. And if we just carve through here, then you can forget all these lines and then look at the next point. And but if you plot all these points, and there's nothing mathematical, there's nothing exceptional about this. This is pure support and resistance. That's all it is, pure price action. You know, I don't need anything else. I don't need moving averages. I don't need fibs. I don't need Elliott waves. I don't need anything. If you can just identify simple price action, support and resistance, you can trade any market, any chart in the world. Right, well, if there's nothing else for you guys and girls, I think we'll call it a day for today. Last chance, put anything up in the comments if you want to, if you want me to look at something quickly. Just to repeat, in the meantime, be very careful trading the yen. Obviously, we're also going into a weekend, so if they do want to do something, they could do something as the Kuruchi drops off this afternoon. They can do something Sunday night, Monday morning. So just be very careful if you're holding yen over the weekend. If you want to take the sensible option, you can always get out and re-enter if nothing happens over the weekend or first thing Monday. Aside from that, have a very good weekend. Thank you, as always, for coming to the Flow Show and supporting us here each and every day. Your company is most welcome. It's a pleasure to have you here. Have a great rest of your day. Have a great weekend. Come on, England. And we'll see you all next week. I might not see you Monday. Depends how drunk I am Sunday. We shall see. Have a good one, everybody. See you later.